Listen, something unprecedented just happened in the silver market. And if you don't understand what it means, you could be walking straight into a financial trap that's been years in the making. I'm about to show you exactly what went down over Christmas, why it matters, and what you need to do before Monday morning changes everything. But before we dive in, if you want to protect your wealth and stay ahead of the market manipulation that's happening right now, hit that subscribe button and turn on notifications. I'm breaking down information that mainstream media won't touch, and you need to see what's coming next. Drop a comment right now telling me if you own silver or if you're thinking about buying. I read every single comment, and your perspective matters. Here's what happened. While you were celebrating Christmas, while Western markets were completely shut down and most traders were offline, the Shanghai Gold Exchange, which handles more physical silver than anywhere else on the planet, recorded something shocking. Silver traded at $82 per ounce. Not a futures contract, not some paper promise. Real physical silver changing hands at $82. Now here's the part they're not broadcasting on financial news. At that exact moment, when Shanghai was printing $82, every Western trading platform, Kitco, Bloomberg, your brokerage account, they all showed $74.87. That's a $7 gap between what silver actually costs and what your screen tells you it costs. And that gap is either going to make some people extremely wealthy or destroy them completely. Let me be crystal clear about something before we go further. Nothing I'm saying here is financial advice. I'm not telling you to buy or sell anything. I'm presenting facts and analysis, but you're responsible for your own decisions. Do your research, talk to professionals, and never invest money you can't afford to lose. What I am doing is showing you what's really happening behind the scenes, because this information could change your financial future. So why does this $7 gap exist? Here's what most people don't understand about how precious metals markets work. They operate 24 hours, but they don't operate equally. The Comex in New York, that's where most price discovery happens for silver. It's the futures market that sets the tone. But on Christmas Day, Comex was closed. London's LBMA was closed. For 36 straight hours, the only major market actively trading physical silver was Shanghai. And in that window, without Western banks interfering, without algorithmic selling programs, without the usual paper contract manipulation, the true price of physical silver revealed itself. $82. That's what silver costs when you actually need to get your hands on the metal, not just trade contracts back and forth. Now think about what happens Monday morning when New York opens for full trading. That $7 gap has to close somehow. It can go one of two ways, and this is critical for you to understand. If Western prices jump up $7 to match Shanghai, every trader who bet against silver over the holiday gets margin called. We're talking forced buying on a massive scale, potentially pushing silver to $90 or higher in a single day. But here's the trap, and this is where people lose everything. If the Comex opens and immediately dumps a huge volume of paper contracts, if the big commercial banks flood the market with sell orders to force the price back down, then Shanghai has to come down too. Everyone who bought physical silver in China at $82 is suddenly holding metal worth less than they paid. That's the Monday morning trap. You won't know which direction the gap closes until it's already too late to react. Drop a comment below and tell me what you think. Does the gap close up or down? Are the banks going to win this fight, or is the physical market finally taking control? Your perspective helps me create better content for you, so let me know what you're thinking. Now, this $82 print in Shanghai isn't random. This has been building for months, and the pressure is reaching a breaking point. Silver has gained 158% in 2025. Let me repeat that. 158%. That's the largest annual gain since 1979. We're talking about the biggest move in 46 years. This isn't just another bull run. This is a fundamental shift in the market structure. And here's why it's happening. The physical supply of silver has collapsed. Shanghai Futures Exchange warehouses right now hold just 531,000 kilograms of silver. That's the lowest inventory level we've seen in a decade. The US Mint is out of silver coins. The Royal Canadian Mint can't keep silver bars in stock. Dealers across North America have been on allocation for weeks, which means they literally cannot get metal to sell to you even if you want to buy. And here's what makes this situation explosive. Industrial buyers cannot stop buying silver. Solar panel manufacturers need it. Electric vehicle producers need it. AI data centers need it. These companies can't wait for the price to come down because if they wait, their factories shut down. This is what economists call inelastic demand. When silver was $30, Tesla bought it. And when it hit $50, they were still buying. At $75, they're buying even more. And at $82 in Shanghai, they're buying faster than ever because they know something critical. They know the supply isn't coming back. And in less than 1 week, on January 1st, 2026, China is implementing the most restrictive silver export controls in modern history. Any company wanting to sell silver internationally has to prove they have an annual production capacity of at least 80 tons. Most smaller refiners and traders can't meet that threshold. They're being completely locked out of the export market. The result is simple and terrifying. Chinese silver stays in China. The global supply just got cut by 70%. Think about that. China controls 70% of the world's refined silver supply. When those export restrictions activate, the rest of the world fights over the remaining 30%. And that 30% is already allocated to existing contracts, industrial buyers, and government stockpiles. There's nothing left for retail investors. There's nothing left for the person who wakes up on January 2nd and decides they want to buy silver. So when you see that $82 price in Shanghai, you're not looking at a bubble. You're seeing early price discovery of a market that knows supply is about to vanish. Western markets haven't priced this in yet because Western markets were closed. They were dark. But Shanghai was wide awake. And Shanghai just told you what silver actually costs when you can't get it anywhere else. Now I need to explain something technical because it's absolutely critical for understanding why Monday could be violent. The term you need to know is backwardation. In a normal commodity market, the future price is higher than the spot price. That makes sense, right? If someone agrees to deliver you silver in 6 months, they charge you more than today's price because they have to store it, insure it, and finance it. That premium for future delivery is called contango, and it's the normal state of the market. But when a market goes into backwardation, everything flips. The spot price, the price for immediate delivery, becomes higher than the futures price. And that's not normal. That's a sign of extreme stress. It means people are willing to pay more for silver right now, today, than they're willing to pay for a promise of silver 6 months from now. It means they don't trust the promise. They don't trust that the silver will actually be there in 6 months. Silver has been in backwardation in China for weeks. Even with a $7 premium over Comex futures, buyers are still paying it. They're paying $82 for silver they can hold today rather than $75 for silver they might get in March. That tells you everything about confidence levels in this market. The physical market doesn't trust the paper market to deliver. And here's where things get really suspicious. On Thanksgiving night, November 28th, 2025, the CME Group, the company that runs the Comex Futures Exchange, experienced what they called a cooling system failure at their data center in Illinois. Trading of silver futures was halted for over 11 hours. 11 hours. In the middle of a massive rally, they blamed it on air conditioning. Air conditioning. Do you know what else happened that same morning? The Federal Reserve conducted an emergency repo operation, injecting $24.4 billion in liquidity into the banking system. $24 billion on the Friday after Thanksgiving, one of the quietest trading days of the year. Why? Because banks needed cash immediately to cover margin calls. The speculation in the market, the rumor that nobody can prove but everybody believes, is that a large buyer, probably in Asia, probably in China, put in an order to take physical delivery of a massive amount of Comex silver. And the exchange couldn't deliver it, so they shut down the market, made some emergency phone calls, arranged emergency liquidity, and reopened 11 hours later with a story about cooling systems. I'm not saying that's definitely what happened. I'm saying that's what people who understand this market believe happened. And whether it's true or not, the fact that it's even plausible should tell you how fragile this system really is. The futures market runs on the assumption that most contracts get settled in cash, not metal. If too many people demand physical delivery, the whole system breaks. And on Thanksgiving night, it almost broke. Now we're 1 month past that event. Silver has climbed from $60 to $75 in the West and $82 in Shanghai. The pressure has only increased. The inventory has only decreased. And we're heading into Monday morning where Western traders wake up, see that $7 gap, and have to make instant decisions. Do they chase the price higher? Do they try to short it back down? Do they panic? If this analysis is helping you understand what's really happening, smash that like button right now and share this video with anyone who needs to see it. What we're witnessing isn't being covered properly by mainstream media. They're going to tell you this is just another commodity rally. They won't explain the supply mechanics or the Chinese restrictions, or why $82 in Shanghai is the most important price print of the year. This channel is where you get the real story, so make sure you're subscribed with notifications on, because Monday morning is going to be absolute chaos. Here's what I think happens. I think Comex opens with a violent gap up. I think silver rips to $78 or $79 in the first hour of trading as algorithmic systems try to reconcile the Shanghai price. I think that triggers a cascade of buy stops and short covering that pushes us to $82 in New York by midday Monday. And once that happens, once the West officially acknowledges that 82 is the real price, we don't stop there. We push to 85, then 90, because industrial buyers who have been waiting and hoping for a pullback realize the pullback is never coming. But here's the trap, and this is critical. If I'm wrong, if the commercial banks have enough firepower to smash the price back down, if they dump enough paper contracts to force a sell-off, then everyone who bought at 82 in Shanghai is underwater. Everyone who buys the gap up Monday morning gets stopped out and loses money. That's the risk. That's the Monday morning trap. You're betting that the physical market wins. You're betting the paper market has finally lost control. And if you're wrong, you get crushed. So what should you do? If you already own physical silver, you do nothing. You hold. This is not the time to sell. If silver goes to 90 or 100, you want to be holding it. If it pulls back to 70, you still want to be holding it because this is a long-term structural move. The supply deficit is real. The industrial demand is real. The Chinese export restrictions are real. This situation doesn't just go away. If you don't own silver yet, if you're sitting in cash waiting for a dip, you need to understand something crucial. The dip might not come. We might gap from 75 to 85 and never look back. If that happens, if you miss this move because you were waiting for $70 or $65, you'll be chasing it at 100. The best time to buy was 6 months ago. The second best time is right now. But if you wait until Monday and try to buy into the gap up, you're buying at the worst possible moment right when the trap is most dangerous. Let me talk about mining companies, because this is where a huge opportunity exists. If you can't get physical silver, if dealers are sold out or charging insane premiums, the next best option is owning companies that produce it. At $75 silver, profit margins for silver miners are absolutely massive. Let me give you an example. A typical primary silver miner has an all-in sustaining cost around $22 per ounce. That includes mining, refining, overhead, everything. At $30 silver, they were barely profitable. At $50 silver, they were doing okay. At $75 silver, they're printing money. At $82 silver, they're making $60 of profit per ounce. Now think about what that does to their stock price. A miner producing 10 million ounces a year just went from making $80 million in profit at $30 silver to making $600 million in profit at $82 silver. That's a 7 times increase in earnings. But have their stock prices gone up 7 times? No, most have doubled or tripled, but they haven't repriced to the new reality yet. The market is still skeptical, still waiting to see if this price is real. But once Monday morning's gap confirms that 82 is the floor, once the West admits Shanghai is right, those mining stocks are going to explode. And the beautiful thing about miners is they're liquid. You can buy them, you can sell them. You're not dealing with premiums or shipping delays or storage fees. You just click a button and own a piece of a silver mine, generating $60 per ounce in free cash flow. But you have to be selective. Not all miners are equal. You need ones that are unhedged, meaning they haven't locked in future sales at lower prices. You need ones in safe jurisdictions because if silver hits $100, governments will start talking about windfall taxes or nationalization. And you need ones with low debt because high leverage works both ways. If silver pulls back, leveraged miners get destroyed. Now let's talk about what happens if I'm right. If silver gaps up Monday and holds above 80, what comes next? I think we're looking at a 3-stage move. Stage 1 is gap fill and confirmation. That's Monday through Wednesday. We gap from 75 to 80, maybe 82. We consolidate and hold. The shorts cover. Algorithms recalibrate. By Wednesday, $80 is the new floor. Stage 2 is industrial panic. That's the rest of December into January. Chinese export restrictions go live. Supply tightness becomes undeniable. Industrial buyers who thought they could wait start placing orders at any price. We grind from 80 to 90, then 90 to 95. This stage is slower, not a panic spike, just relentless buying with no sellers. Stage 3 is public mania. That's when silver breaks $100 and makes the front page of every financial news site. That's when your uncle, who hasn't thought about silver since 2011, calls, asking if he should buy. That's when ETFs see massive inflows. That's when momentum traders pile in. And that's when we go from 100 to 120, maybe 150 in weeks. But here's the thing about stage 3. By the time it happens, you're not buying anymore. You're selling, or more accurately, you're swapping. You're taking your silver and trading it for something productive. Real estate, a business, or gold at a favorable ratio. You're not selling it for dollars, because by the time silver is at 150, the dollar is in free fall. That's why silver is at 150. You don't trade the hardest asset for the softest currency. You trade it for another hard asset. The gold to silver ratio right now is about 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Historically, that ratio has gone as low as 15 to 1 during silver manias. If we get back to 30 to 1, which I think is very possible, you can swap your silver stack for twice as much gold as you can today. That's the trade. You ride silver up, swap into gold at the peak, preserve your wealth without ever touching fiat currency. Now, let's talk about the elephant in the room. What will the government do? Because make no mistake, if silver goes to $100, if it disrupts industrial supply chains, if it creates a financial crisis for banks that are short, the government will intervene. They have to. They can't let a commodity market blow up the derivatives complex. So what tools do they have? First, they can raise margin requirements on futures contracts. They've done this before. In 1980, when the Hunt brothers tried to corner the silver market, Comex raised margins to 100%. You had to put up the full value of the contract just to hold the position. That killed the rally and forced liquidation. They'll do it again if necessary. Second, they can implement position limits. They can say no single entity can hold more than a certain number of contracts. This prevents hoarding and short squeezes. It gives commercials breathing room. It's a blunt tool, but it works. Third, they can declare force majeure. This is the nuclear option. The exchange or clearinghouse declares that due to extraordinary circumstances, they cannot fulfill their obligations. Contracts get settled in cash at a price they determine, not the market price. If you're long silver at 100 and they declare force majeure and settle you out at 80, you just lost 20% and there's nothing you can do. This is why physical silver in your possession is so critical. They can manipulate the paper price. They can change futures exchange rules. They can halt trading. They can force cash settlement, but they cannot take metal out of your safe. If you hold it, you own it. When the dust settles, when contracts are unwound and lawsuits are filed and new rules are written, the person holding physical metal wins. Now I want to address something I keep seeing in comments and on social media. People asking, should I wait for a pullback? Should I wait for silver to come back down to 70 or 65 before buying? I understand the logic. Nobody wants to buy the top. Nobody wants to buy at 82 and watch it drop to 70. But here's what you're not considering. What if it doesn't pull back? What if Monday gaps up and we never see 75 again? Think about it. Shanghai's price is 82. Western price is 75. That gap has to close. It closes by Shanghai coming down or New York going up. If you're waiting for a pullback, you're betting Shanghai comes down. You're betting Chinese buyers suddenly lose interest. That industrial demand evaporates. That export restrictions don't matter. Do you really think that's happening? Or is it more likely New York catches up to Shanghai? That Western traders wake up Monday and realize they've been wrong? That the paper price has been suppressed? That the real price is 82 and going higher? If that's what happens, and I think it is, then waiting for a pullback is the same as waiting to miss the move entirely. Before we wrap up, tell me in the comments, what's your move Monday morning? Are you buying the gap up, holding what you have, waiting on the sidelines? Drop your strategy below. And listen, if you got value from this video, if you understand the Monday morning trap better now than you did 10 minutes ago, smash that like button. It helps the algorithm show this to more people who need to see it. Share this video with anyone who owns silver or is thinking about it, because what's coming is going to catch a lot of people off guard. Let me tell you what happened in 2020. Silver was trading at $12 in March of 2020. Refineries shut down because of COVID. Physical premiums exploded. You couldn't buy a silver eagle for less than $25, even though spot price said 15. People waited for premiums to come down. They waited for the market to normalize. By the time it did, spot was at 30. The pullback never came. People who waited paid double. This is the same setup, but bigger. Refineries aren't shut down because of a virus. They're shut down because there's no metal. Premiums aren't high because of temporary demand. They're high because of structural deficit. And the gap between physical and paper isn't $2, it's $7. If you wait, you're going to pay more, not less. Now, I want to be very clear about something. I'm not telling you to buy silver. I'm not your financial advisor. I don't know your situation or risk tolerance. What I am doing is laying out facts as I see them and explaining the mechanics of what's happening. You have to make your own decision. Always do your own research. Consult with qualified professionals. Never invest money you can't afford to lose. But if you're asking what I would do, here it is. If I didn't own any silver, I'd be buying right now. Not all at once, not going all in at 75, but scaling in. Buying a little bit every day, regardless of price, because I believe the trend is up. And I believe the risk of missing the move is greater than the risk of a short-term pullback. If I already owned silver, I wouldn't be selling. I'd be holding and being patient because even if we pull back to 70, even if Monday is a disaster and the gap closes down instead of up, the long-term trajectory is clear. The supply deficit is real. Industrial demand is real. Chinese restrictions are real. This is a multi-year bull market and we're still in early stages. And if I was looking for leverage, if I wanted to amplify returns, I'd be looking at miners. Not ETFs, not junior explorers with no revenue. I'd be looking at established producers with low costs, strong balance sheets, and exposure to rising silver prices. Because when this really gets going, when we're at $100 silver and mainstream media finally pays attention, those stocks could be up 500 to 1,000%. Let me paint you a picture of Monday morning. You wake up and check your phone. Silver is trading at $78 in pre-market. It gapped up $3 overnight. You're excited, nervous, wondering if you should buy. By the time markets officially open, it's at 80. Momentum is building. Shorts are covering. Algorithms are chasing. Within an hour, it's at 82, matching Shanghai's price. Now the question is, does it stop there or keep going? If it stops, if 82 is the top and we spend days consolidating, then okay, you have time. You can wait and watch. But if it doesn't stop, if it blows through 82 and hits 85 by lunch, then you're chasing. And chasing is how you lose money. The trap is not knowing which scenario plays out until it's too late. That's why it's called the Monday morning trap. The decision you make in the first hour of trading could define your next 12 months. Do you buy into strength and risk a pullback? Do you wait and risk missing the move? There's no perfect answer. Only the choice you make and consequences that follow. What I can tell you is this. People who win in markets like this aren't the ones who time the bottom perfectly. They're the ones who recognize the trend early and have courage to act on it. Silver at 75 is expensive compared to 6 months ago, but it's cheap compared to where it's going 6 months from now. The question is whether you believe that, and if you believe it, whether you're willing to act on it. We're living through the greatest wealth transfer in modern history. The currency system is failing. Paper markets are breaking. Physical assets are becoming unobtainable. People who understand what's happening, who position themselves correctly, are going to come out wealthier than they imagined. But people who sit on the sidelines, who wait for permission, who need absolute certainty before acting, they're going to be left behind. Silver hit $82 while markets were closed. That's not a headline, that's a signal. It's a message from the physical market to the paper market saying, we don't care what your algorithms think silver is worth. We know what it costs to get it, and the cost is $82. The question now is whether the paper market accepts that message or fights it. My guess is they fight. They'll try to smash it back down. They'll flood the market with sell orders. They'll raise margins. They'll do everything to regain control. But I don't think it works this time. Physical demand is too strong. Supply deficit is too severe. Chinese restrictions are too binding. And when the paper market finally admits defeat, when they accept that 82 is the floor and not the ceiling, that's when this goes parabolic. That's when we go from 82 to 90 to 100 in weeks. And if you're not positioned by then, you're not getting positioned, because once mania starts, once the public piles in, premiums go insane. You'll be paying 120 for a silver eagle when spot is at 100. The window closes fast. Here's what you need to understand. The Monday morning trap isn't just about Monday. It's about the entire next phase of this bull market. It's about whether you recognize what's happening and act accordingly, or whether you hesitate and miss it. People who bought at 25 and held through volatility are sitting on 300% gains. People who waited for a pullback that never came are still waiting. Don't be the person still waiting when silver is at 150. Don't be the person who looks back in 2 years and says, I knew it was going up, but I didn't buy. Because that regret is worse than any short-term loss. You can recover from buying at the wrong price. You can't recover from not buying at all. The choice is yours. The information is in front of you. The mechanics are clear. The catalysts are real. What you do with that information is up to you. But whatever you decide, decide fast, because Monday morning is coming, and when it does, the trap snaps shut. Make sure you're subscribed to Final Wealth Warning. Hit that notification bell, drop a comment with your thoughts, and share this with anyone who needs to hear it. The next few days are going to be historic, and I'll be here breaking down exactly what it means. I'll see you in the next one.